everyone. Good morning, good afternoon, and good evening. Thank you for joining us today. My name is Daniel Wang, and I'll be your moderator for today's panel. So just a quick introduction about myself. I head the insurance department at the Monetary Authority of Singapore, and I'm also the chairperson of the newly established IAIS Climate Risk Steering Group. So today, of course, we are here for this very important panel topic, and certainly a very topical one. And I'll just maybe just say a few things before I pass the time over to the IAIS Secretariat. So the climate change, as you all well know, is the existential crisis of this generation. It is projected to have profound implications on the financial system and the broader economy. So to understand its impact, central banks and supervisors are increasingly undertaking scenario analysis, and the insurance industry is also doing likewise. So scenario analysis is, of course, a tool to identify, assess, and understand the impact of the physical and transition risks associated with climate change. Several countries have made progress on climate scenario analysis, overcoming some of the challenges, such as quantifying the impact of climate-related risks, mapping economic consequences of physical risks, and designing scenarios that strive to be science-based as well as plausible. However, we also recognize that there can be challenges to developing long-term models, especially given the non-linear effects of climate change. So in this emerging space, there are other challenges such as data availability. For instance, Scope 3 emissions data, as well as climate data coverage tends to be more scarce for illiquid assets and derivatives. There are also data quality issues at the company and possibly at the data provider levels. This can, of course, hamper comparability and poses some obstacles to effective modeling. So notwithstanding all these challenges, we are here today to try to see how we can go together, whether insurance supervisors or the industry, to learn the lessons together and collectively embark on this journey. So I hope today's panel can give you some insights into the concrete steps that we can take to improve climate scenario analysis and assessments going forward, including asking questions like what mindsets have to change as we go through this journey. So today we are very privileged to have two regulators, an industry player, and a non-profit organization to share their experience and expertise with us, and what some of the key considerations and challenges are with climate scenario analysis. We also hope to explore what's next and what role the IAIS and insurance supervisors can play to support all the members here. So before we begin the panel session, can I invite Ms. Anna Van Voden, who is the Head of Supervisory Practices and Operations at the IAIS Secretariat, to share on the IAIS's recent climate scenario analysis work. This is found in the Global Insurance Market Report, special topic, which applied scenario analysis to study the impact of climate change on the financial stability of the insurance sector. So without further ado, can I pass the time over to Hannah?
Thank you so much, Daniel, for your introduction to this topic and to the panel. And welcome everyone also on my behalf. To provide some context for today's panel, I will spend just a few minutes to share the IAIS own experiences with climate scenario analysis. As mentioned by Daniel and also by other speakers during earlier today's town hall, indeed in September we published a report which assesses the extent to which insurance investments are exposed to climate change. The report draws on unique quantitative and qualitative data that we gathered from more than 30 IAIS members across the globe, covering more than 75% of the global insurance sector premiums. The analysis in the report focused on those asset classes that are most relevant to a typical insurer's investment portfolio: equity, corporate bonds, loans and mortgages, sovereign bonds, and real estate. And the data collection and analysis showed that more than 35% of those assets could be considered as climate relevant. In other words, exposed to climate risks. This includes, for instance, exposures to counterparts in the housing sector or energy-intensive sectors. And as mentioned also by Daniel, we also use scenario analysis to explore the forward-looking nature of climate change risks. The scenario analysis performed in our report utilizes those scenarios developed by the Network for Greening the Financial System, or NGFS, and focuses on the impact of an orderly transition, a disorderly transition, and a so-called too little, too late world. And the outcomes of our analysis clearly highlight the benefits of an orderly transition towards climate targets, both from a solvency perspective as well as a financial stability perspective. However, there's still work to do to strengthen our analysis, not least the need for joint efforts to overcome the conceptual and methodological challenges that come with climate scenario analysis. Daniel already alluded to them as well. These include, for instance, issues with modeling long-term and nonlinear effects of climate change, issues around data gaps and issues around data gaps and lack of supervisory reporting around climate-related risks, as well as the need for a globally consistent framework for measuring climate-related financial information. In the next 90 minutes at the panel, we can expect to touch upon these and other challenges as we learn from the experiences of our panelists. From our side at the IAIS, we really value these interactions as they help us further our work and feed into the next stages of our work. On the data side, we will look to integrate climate risk into our regular annual financial stability analysis and data collection, our global monitoring exercise, or GME. On the scenario analysis side, we just started a project, as also mentioned during the town hall, that will take stock of work done by members, by the NGFS, and based on that, we will identify areas where we can add the most value for our members, such as by developing guidance on supervisory good practices. Without further ado, I will hand back to Daniel to start the panel discussion. Thank you very much.
Thank you, Hannah, for your sharing. So to kick off today's session, please allow me the privilege to introduce our panelists. And of course, ladies first. So we are happy to have here today Dr. Nina Chan. She's the Vice Chair of the IAIS Climate Risk Steering Group, and of course, I work very closely with Nina. So Nina is also the Executive Deputy Superintendent of the Climate Division at the New York State Department for Financial Services. So under her leadership, the DFS has established a set of expectations and guidance to integrate climate-related financial risks into risk management and governance practices. Next, we have Ms. Anna Sweeney. She's the chairperson of the Sustainable Insurance Forum. Anna is also from the UK PRA, and she's the executive director responsible for its risk and operations function, as well as co-leading the insurance supervision at the PRA, being responsible for the supervision of the UK's general insurance sector. I would also like to extend a warm welcome to Renaud Guidet, who is the Group Chief Risk Officer of AXA. Renaud currently chairs the UN-convened Net Zero Insurance Alliance. Prior to AXA, he was a Managing Director of Investment Banking with Goldman Sachs and had assumed roles within the French Finance Ministry. Renaud's background will lend itself to provide us with private sector insights on climate scenario analysis. Last but certainly not least, we have Jacob Tomei, co-founder of 2 Degrees Investing Initiative, 2DII Network, which has operations in New York and Berlin. 2DII has collaborated with supervisors such as the Bank of England, EIOPA, and the Japan FSA to introduce climate scenario analysis into regulatory practices. Last year, Jacob launched the 1 in 1,000 research program designed to integrate complex and long-term risks into financial supervision and decision-making. So before I start today's panel session, I would also like to inform the audience that we will have 2 polls for the audience introduced one after the other. You can find the polls on the right-hand side of your screens. The first poll is on the main purpose of climate scenario analysis, and we encourage those joining us today to participate in this polls. For instance, for poll number 1, and I hope you can see it on the screen, The question is, what should be the main purpose of climate scenario analysis? Whether it's to provide a microprudential view, a macroprudential view of risk, or both. So I hope I welcome the audience to start entering your suggestions into the poll, and we will come back to the results shortly. So at this juncture, why don't I start to kick off our first segment. There is growing international consensus from supervisors as well as insurers on the role that climate scenario analysis plays in assessing the effects of climate-related risks. So how does climate scenario analysis support supervisory objectives, as well as a financial institution's climate risk management goals? What are some of the challenges faced? These are some of the issues I hope to invite our panelists to share their initial insights on. So maybe let's start with Anna. As an insurance regulator at the PRA and as chair of the SIF, you'll be extremely familiar with applying scenario analysis from a micro as well as a macro prudential perspectives. Perhaps, Anna, you can share with us the different purposes of climate scenario analysis as well as their benefits.
Thanks very much, Daniel. Thanks for the opportunity to join in the panel. I'm looking forward to hearing both from other panelists, but also from the questions. I guess I would preface everything I'm about to say with the fact that we're all still learning about this. I know a number of colleagues internationally have carried out some stresses, and it's been really interesting. But I think one of the reasons why it's important on both the IAIS agenda and the SIF agenda is that this is something that we can all benefit from learning through each other's experiences. Having said that, with that big caveat up front, I think top-down regulatory-led scenario analysis has benefits for both macro and micro supervision. Macroprudential assessments provide insight into financial system-wide risks, including the distribution of potential outcomes and system linkages. This might be achieved by a supervisor translating climate variables such as temperature changes into economic impacts, including GDP, unemployment, interest rates, real estate prices. Supervisors often use macroeconomic models to translate the effects of climate risks on the economy and financial system. Those macroeconomic impacts can then be used to estimate changes in risk profiles, such as a change in PD, loss given default, or market prices. Supervisor can use this kind of analysis to reveal exposures and vulnerabilities to climate risks at a system-wide level. Macroprudential assessment can be beneficial to understanding the vulnerabilities of the entire system, while developing proxies for risk that can be useful in downscaling into more detailed assessments. Microprudential assessments look at specific risks to financial firms, including the impact on balance sheets and income statements. To effectively design a microprudential analysis, the supervisor might identify the nature of the underlying exposures to be assessed, which might include the investments or underwriting business of an insurer. Different models might be used to estimate the vulnerability of a firm or firms at a more granular level, such as natural catastrophe models that reflect changing climate patterns. Here, strategies of counterparties to address the risks posed by climate change may also be accounted for and reflected in the assessment of the financial exposure. These assessments can be helpful to understand the exposures of a firm at a more granular level and reflect the firm's and its counterparties' strategies for mitigating the risks to which they're exposed. Intuitively, common scenarios across the industry allow regulators to assess the resilience and identify vulnerabilities within or across sectors. But such exercises also allow supervisors to compare and contrast their firm against its peers, particularly in respect of how a firm's risk management responds and their capability in quantifying the risk. Such output helps them to inform and drive risk-based supervisory activity. Arguably, longer term for climate scenario analysis, these objectives are no different. However, the complexity is far harder. For example, the timescales are typically beyond normal business plans. Well, indeed, well beyond normal business plans. And the potential impacts are far more widespread, recognizing that climate change has a global impact. As such, the current climate stress test that we're doing here in the UK seeks not only to assess the market's capabilities, but also to support the market to develop in this area. Hence, a key part of this exercise is to learn by doing bringing me back to where I started, with the bank's feedback being used to support continued development in such a complex area. Thanks, Daniel.
Thanks, Anna. And so I mean, you mentioned twice learning by doing, and I think this is really resonates with the earlier point I was making as well in the introductory remarks, that this is a journey that both supervisors as well as insurers are undertaking, and can and should be seen in that spirit. Maybe if we can just take a look at the results of the poll, understand the results are already in. Yes, so on what is the main purpose of climate scenario analysis, micro and macro, it's a resounding yes to and affirms what Anna is saying, so that it really serves dual purposes. And okay, so thank you, audience. We will introduce the second poll later. Maybe back now to my fellow panelists. UPSA's 2021 climate report had mentioned that the development of climate scenario analysis and stress testing has accelerated largely due to, I quote, the pilot climate exercise launched by the ACPR. So maybe a question to Renaud. In your role as the CRO of AXA, what has the journey been like for you as an insurer in terms of developing climate scenario analysis capabilities?
Well, great question, Daniel, and thank you very much for raising it, and more broadly for hosting this event. Thanks to all the IAIS team. Very happy to be with you all today. Our role is to provide protection to our customers, and through that to protect our communities, the economy, and the society at large. So to put it short, we are in the business of managing risks. And obviously, climate-related risks are part of that and are definitely incorporated in the way we approach it. As insurers, we are accustomed to managing the consequences of extreme weather events, and that forms part of our bread and butter, and it has been so for years now. So what we do is obviously that we incorporate that in our modeling, and we have a forward-looking approach to it, to make sure that we can incorporate the likely development of various parameters and their impact on what we insure and the coverage we provide to our customers. And the fact that that there are climate scenarios does help us to encompass the various dimensions, namely hazard, the frequency and the severity of climate-related events, the exposure, so to which extent the insured base is actually exposed to such perils, but also the vulnerability, because we can definitely foster resilience in our communities. And I would like to dwell actually on that latter example, the one of vulnerability, to shed light on the fact that through climate scenarios, actually, we insurers can have an impact on climate adaptation, but also on climate change, mitigation. So to start with adaptation, I think that's a very striking example, which comes from Hurricane Ida, which, as most of you remember, hit the US approximately 2 months ago. First, through the Gulf states, Texas, Louisiana, and then moving up northeast to New England. Interestingly enough, when Ida hit the city of New Orleans in Louisiana, it did so with the same intensity as the infamous Katrina hurricane back in 2005. However, the loss was actually 5-10 times lower this time around. Why is that? Because basically we had been erecting flood defenses, barricades, so literally making sure that there would be barriers that would enhance the resilience of the communities and limit their vulnerability. So it shows that all of us together can have an impact on climate change adaptation. And there's a lot of talk, on the human influence on climate change. And I think it's very important that the IPCC report in its latest edition made it clear that human influence unequivocally does impact climate change. but symmetrically, we can also, us humans, have an impact on climate change adaptation. As for mitigation, we do believe that as insurers, being a financial services player across the value chain with very large balance sheet, we can actually do a lot to put our resources to work to fend off the drivers of climate change and try to limit the pace of warming. So this is why AXA has taken the lead to create the Net Zero Insurance Alliance, which I personally chair and which gathers insurers and reinsurers worldwide. And it's part of AXA's leadership, which dates back to the fact that back in 2015, we were the first global insurer to exit coal. Some of you may have seen that less than 1 month ago, we also announced new drastic and stringent commitments on oil, especially new oil projects and non-conventional, which once again are a breakthrough in the industry. And through all of that, we want to really have a comprehensive and total approach, to net zero through our underwriting, and that's part of the Net Zero Insurance Alliance I just mentioned, but also through our investment and asset management arm, and obviously on top of that, cherry on the cake, through our operations, which are obviously greener and for which we also committed to net zero. So definitely climate change scenarios and stress tests do help us, along the way to make that very credible and robust.
Yeah, thanks, Reno. I think AXA has really done a lot and as you said, played a clear leadership role and setting an example for certainly European insurers and maybe also the rest of other insurers globally. On the New York DFS side, Nina, the DFS has also been ramping up its work on climate-related issues this year, with an increased focus on climate change-related issues during your supervisory engagements. I believe the DFS also issued its final guidance for New York domestic insurers on managing the financial risk from climate change yesterday. There are also plans, I understand, to publish a report on transition risk. So coming from your perspective as an insurance supervisor, where would you describe supervisors and the industry as being at in terms of the development of scenario analysis?
Thank you, Danielle, for inviting the IAIS for inviting me to this very important discussion. So to give you the legal context of scenario analysis for insurers, and maybe it's similar in other jurisdictions, New York insurance law states that insurers' enterprise risk management functions must identify and measure risk under a sufficiently wide range of outcomes and use prospective solvency assessments, including scenario analysis and stress testing. So like like Renaud has mentioned, P&C insurers have been stress testing natural catastrophe, and the life insurers have been stress testing certain economic and market downturns on the assets for a while. What I would say is the biggest difference I'm seeing between what insurance have traditionally done versus what climate scenario analysis will require is the long-term time horizon, the inclusion of transition risk, and also the interaction between underwriting and investments. So this year, we did a thorough analysis on where New York domestic insurers were on managing financial risk from climate change by reviewing their 2020 responses to the National Association of Insurance Commissioners Climate Risk Disclosure Survey. The survey has been ongoing for more than 10 years and has a wealth of information. What we found was that some leading P&C insurers have customized commercial catastrophe models to be more forward-looking and analyze their underwriting scenarios over several decades. There are several insurers conducted scenario analysis that consider the impact of physical and the transition risk under various scenarios, use both short-term and long-term horizons. For medium to smaller insurers, this is still a developing area. We also observed that P&C insurers overall were more sophisticated than life insurers on scenario analysis, and health insurers were the least sophisticated. This was not surprising since P&C insurers have been dealing with natural catastrophes for a long time. This was also an area where we saw the largest dispersion among the various themes in that survey. So the survey covers risk culture and governance, risk management, modeling and scenario analysis, stakeholder engagement, and internal greenhouse gas management. We see that the difference among insurers were the largest in the scenario analysis theme. In terms of supervisors, I would say climate scenario analysis is also a developing field for US supervisors. A few years ago, California analyzed insurers' asset exposure to transition risk through Jacobs' organization using the PACTA model. We did a similar analysis last year with PACTA, which I'm happy to talk about more. I'm not aware of other US supervisors having done so, but as part of the IAIS Global Insurance Market Report this year, that Hannah mentioned earlier, NAIC contributed to the data used for the analysis. Lastly, I just want to flag that a few weeks ago, the US Financial Stability Oversight Council, whose members include all the federal financial regulators, released the climate risk report where it recommends that its members conduct scenario analysis of the climate-related financial risk where appropriate. The Federal Reserve Board is also developing a climate scenario analysis program. So I hope that these developments will also help move the climate scenario analysis field forward in the US. Now, Daniel, I'll pass back to you.
Thanks, Nina. Jacob, so you have heard from Anna, Renaud, and Nina. Just wondering if you have any additional points to add and to share.
Sure, and thanks for the opportunity to share today at this conference, especially with such a great panel. Maybe I think one of the things is we talk a lot about how climate change is sort of influencing how we need to supervise risk, but these processes that we've just heard from the Bank of England, from the New York Department of Financial Services, and from AXA, I think it's interesting to also think about how they transform stress test frameworks more generally. They are really almost a canary in the coal mine, no pun intended, for new ways to think about risk supervision beyond the, dare I say, somewhat traditional now in the interim and some perhaps even stale process of stress testing frameworks that can come with a lot of problems. And I mean, just to give you a few examples, what Nina highlighted from the New York DFS is centralized scenario analysis exercise with minimal transaction costs. I think is such an interesting way to complement these long periods of stress tests that take a long time, are very expensive to implement. The use of new economic data inputs, right, beyond just financial data, looking at production data or asset data, activity data, forward-looking CapEx data to really get a picture for risk profiles and do dynamic stress testing. You know, we've talked to supervisors where actually these forward-looking plans are, the stress test shocks are calibrated based on the forward-looking plans of companies and not just as a generic sector code or asset class. And of course, the comparability coupled with the flexibility, right, where you see exercises where there is one model and, you know, the work that Nina has been doing, it's 100% comparable across all insurance companies, but there is flexibility in the model to adapt to different cases. Maybe just two other points for the discussion. So I think it's really obviously important, you know, we do use the word stress test, scenario analysis, sensitivity analysis somewhat interchangeably. And I think it's important we recognize that these are different types of exercises with different use cases. And actually it's important that stress test mechanisms aren't just, you know, the only way to think about this, this framework. And I think two examples here is thinking about alignment analysis is increasingly what supervisors are doing, not just risk, you know, as a way to sort of gauge, is risk increasing or decreasing over time rather than just what's the level of the risk. And even scoring methods, which are, you know, come with their whole set of problems, but are also interesting in this regard. Finally, maybe I think we're really now in an area where it's about what do we do with the results and the behavioral challenges of taking what in some cases are quite long-term projections and long-term scenario analysis exercise. I know Anna at the Bank of England, that's obviously a very long-term perspective that you're taking here with those risks. And how do we translate that into decision-making today? And there is a whole host of different areas, maybe just to give you one example, right? So what's interesting if I think about what AXA is doing is that, you know, AXA in some ways now projecting potential risk profiles and by extension premiums for maybe 10, 20, 30-year horizons. But when you're signing insurance contracts, home insurance contracts, they're still only on 1 year horizon. The consumer who is building a new home somewhere doesn't know that maybe the insurance company they're interfacing with, that their internal models think some of these assets might be uninsurable in 30 years or at significantly higher premiums. So I think we really need to do a lot more thinking now into how we can address the behavioral component of long-term risk supervision, and maybe also make sure that the end user benefits from this innovation.
Thanks, Jacob. Very insightful points. I want to pick up on the phrase you use, the interchangeability of stress testing, sensitivity analysis, and of course scenario analysis, and what you said about there being different use cases. In fact, this is something that we hope to go into this next segment, use cases, right? So we have heard about the different purposes of climate scenario analysis from our two lady regulators here, as well as from Renault, from a firm-specific view. So it's certainly valuable to help to assess the impact of climate-related risks, but exactly how can we go about implementing it? What makes climate scenario analysis and exercise effective? So these are the questions we hope to the panel will soon dive into in the next few moments. But before we go into that, just a reminder to everyone listening in, the second poll will now be open. And again, invite you to put in your vote for the poll. Likewise, you can see it on the right-hand side of the screens, and we'll come back to the results later. So we ended off with Jacob last, but now I want to go to Jacob first. So Jacob, the 2DII has helped to introduce climate scenario analysis as well as stress testing into regulatory practices. And as I mentioned, you have been collaborating with governments as well as insurance supervisors globally. And we also know that stress testing has been very much a part of the OSA process, and supervisors have also been using stress testing as a supervisory tool. So in your experience, what similarities or differences do you see with the development of climate scenario analysis when compared to stress testing?
Sure. So, I mean, the first thing is the dynamic, and this is, I think, really a positive sign that we need a combination of bottom-up and top-down processes, right? So something like what the New York Department of Financial Services has done, or IOPA, or even the Bank of England in the past, where there's centralized, analytical exercises about how these risks are affecting insurance companies, and availability of insurance portfolio data that is in some cases more recent, in the European case through Solvency II, has made this type of work possible. And then we still need the institutions to do some of the work themselves, like through ORSA. And that is, of course, because we do see a dramatic difference in how this is internalized. If you just have the supervisor do it for you, I mean, this in our personal life. When somebody does the work for you, if somebody does your homework for you, you don't learn necessarily. And so we need to make sure that, the insurance companies are doing their homework just as the supervisor or central bank is sort of accompanying that process. So that's, I think, the first thing I'd say. And then there is I think, a funny dynamic now where, we are increasing the complexity of the exercises, the sophistication. And that's making it increasingly hard for certain regulatory tools to be deployed in response to these exercises. And the reason, of course, for that is that as we increase complexity and we introduce uncertainty, it becomes harder to legitimize a political or regulatory intervention like changes to capital requirements, because we're just dealing with such complex models and such uncertain infrastructure. So I think just as we have sort of a top-down, bottom-up framework in terms of running these processes through, I think we also need to think about maybe having sort of a simple and complex process in parallel, especially if you think about using stress tests for capital requirements. In some ways, it might make more sense in those cases to really think about simple aspects like exposure limits, not in the sense of exposure limits, actually hard limits, but saying, if you have a certain concentration risk related to transition risk, then you need to think about maybe holding a bit more capital. And that might be more simple than a very sophisticated scenario analysis model with 15 different scenarios telling you that the risk is a bit higher or a bit lower, right? It's just easier to implement that way. Again, I don't want to steal your thunder, but obviously work together on this. I'm thinking in particular about some of the insurance companies in New York that had, I think in one case, even 100% of their equity holdings in fossil fuels. So that feels like you don't need 100 different climate scenarios to think this might be a bit of a flag in terms of a concentration risk. But then I do think, as we think about scenario analysis, I still think we're just at the tip of the richness that can provide us as insights. And it really becomes so much more of a tool for capacity building and for designing regulatory dialogue than just a very sort of traditional confrontational piece around, I say A, you say B, and now you have to be penalized, right? I think that's what makes it so powerful. And when I say tip, I mean, just thinking about the conversations I have with some supervisors that we're looking at running maybe 100 different scenarios in parallel, changing the question from are you solvent under this scenario or not to under how many features are you solvent. I think it's so interesting that we can really be more bold in how we use these tools, not in the sort of bold in the sense of now we have to use them in all of our regulatory interventions, but in the analytical insights that we can get from them. And I think that's where, it's extending the time horizon, delaying the start date of the shock, having delayed stress test, running 100 scenarios rather than 2 or 3. I think all these innovations are really what sets scenario analysis apart from traditional stress tests. I'm so sorry that was such a long answer. I know we have a limited time today, but it's just I think such a fascinating space at the moment, this dynamic.
Thanks, Jacob. In fact, perhaps with assistance with experts like yourself and to the II, supervisors have been making substantial progress in this area, and none other than we have one of them here, at least. So Anna, in his recent speech, Governor Andrew Bailey mentioned that the Bank of England will further utilize scenario analysis to identify the different transition pathways to meet net zero commitments. And the Bank of England has certainly been one of the most progressive supervisors in this space. So based on your experience at the bank with scenario analysis, as well as from the breadth of experience that has been shared within the SIF supervisory community, what advice would you give supervisors that are still in the initial phases of developing climate scenario analysis? What views do you have on some of the key elements that should go into scenario analysis, whether it's in terms of designing the time horizon, about static or dynamic parameters, or maybe even what's the right balance to strike between quantitative and qualitative inputs?
Thanks, Daniel. I think the first place I'd make is just to start. It might seem daunting to decide a number of the elements that you talk about at the outset, but there'll be lessons to learn just from the process of going through that set of decisions. And I don't think we as yet completely know what the sort of right parameters are, but the exercise of doing it is helping us learn and narrow that down. There are, of course, resources to help support work for those regulators who haven't yet started thinking about it. Both the IAIS and the SIF are working together to support members with guidance and resources for insurance-specific climate analysis. And the NGFS, of course, has published scenarios to help with translating climate science to economic impact, as well as producing guides for supervisors to implement the work. On the horizon or the balance sheet, as I said, I don't think there's a completely right or wrong answer. It's going to depend on the nature of the jurisdiction, potential physical and transition risk exposures, and the maturity of the industry's own response to address the risks. It's really important that we don't let the perfect here be the enemy of the good, as we're all learning. For those at the very beginning of the journey, it may be easier, as you suggest there, to focus initially on more qualitative assessments, and through that process, obvious next steps for a future focus on quantitative assessments or particular areas of exposures that naturally arise. So an example is here at the Bank of England, we're looking for the first time at climate litigation risks, and have decided, because this is genuinely the first time that we've had deep conversations with the industry about that, is that we will focus, as part of this largely quantitative exercise, that element of it will be qualitative this year. At the SIF, we're hoping to fast track the process of our members learning how to undertake such analysis, because as a global body, we can facilitate the sharing of the knowledge and experience of those who've already been through the process. We have an open and engaged international regulatory community keen to share lessons that we're all learning with our peers. That obviously goes for the IAIS as well. As I mentioned earlier on, I think one of the outcomes for us in the our own CBES exercise that we're currently in the process of reviewing the first set of results from the industry is to help support the industry itself in building up its capabilities. As such, one of the outcomes of the BES is to inform the trade-offs in scenario design choices, both for the regulators and the firms. All of our choices have resulted in some compromises. For example, static balance sheets should improve comparability across firms, but as a result, gives no allowance for management actions, which potentially makes it harder for firms to incorporate within broader strategic plans. The bottom-up analysis of individual counterparties fosters broader engagement in transition plans, but can be difficult to merge with top-down analysis, which typically involves implicit assumptions on how different sectors adapt in aggregate across the transition. Given that the very worst physical climate risks are likely to occur later in the century, given the inherent challenges in modelling the effects of climate change over such a protracted time horizon, as Nina and others have mentioned, we shifted forward the climate outcomes that could materialise between 2050 and 2080 in the absence of further policy action, so that these fit within our 30-year timeline, i.e. occurring in the between 2020 and 2050. In addition, in light of the large degree of uncertainty surrounding temperature pathways, as well as the modelling uncertainty related to physical risks, the bank calibrated the temperature pathway according to the 90th percentile of projected distribution of warming outcomes, conditional on no further policy action. Furthermore, a key consideration is the level of prescription that regulators provide in scenarios. In our climate stress test that we ran for the insurance sector in 2019, the test was arguably too prescriptive. For example, factor-based charges for investment, resulting in limited capacity building. As Jacob said, it's important that everyone is learning here, not just taking things that are prescribed by the regulator. CBES allows greater flexibility of approach and requires participants to expand the scenarios provided. This is certainly increasing, we believe, the capabilities of firms, but results obviously in potential for greater divergence of outcomes, even after allowing for the static balance sheet. Moreover, the inclusion of a complementary qualitative questionnaire is trying to compensate for some of that with understanding of how participants might change their business models to mitigate the risks, i.e. the management actions, including management of emerging or novel risks, such as reputational risks, or indeed the climate litigation that I mentioned earlier. So just to reiterate the point I made at the beginning, I don't think there's a perfect set of answers, but I think that the discussion around setting up and then the engagement through the exercise with the firms themselves is helpful and is helping us all to learn. I know there are a number of stress tests underway around the world, and I think we're all looking forward to learning the lessons, not just the pure number answers at the end of it, but learning lessons from those. Thanks, Daniel.
Thanks, Anna. So on that note about learning from each other, let's hear from another supervisor. Nina, what plans does the DFS have to further scenario analysis work at the department and as well as with your industry? What will be your key considerations in doing so?
Yeah, so like Jacob, I mentioned earlier, and Jacob also touched upon, the scenario analysis we partnered with 2DI on, we're really very appreciative of their partnership with us. Otherwise, we wouldn't have been able to do it. So when we think about what to require in terms of scenario analysis, so since we're still at the very early stage of this work, and except for a few of the largest insurers, internationally active insurers, and I would say the majority are still very new to the concept of climate scenario analysis. So what we did this time was to basically do the analysis for them to illustrate that what could be done and the kind of information that can be gained from that. And then hopefully will inspire them to get engaged as well. And now that we have issued our final guidance, we are also in a better position to direct them to start working on the scenario analysis. So maybe I can just talk a bit about the findings that we have learned from this past analysis, which we found was very interesting. So we used our New York domestic insurers 2019 year-end positions. So in the US insurers are required to submit to regulators their position level data on their investments annually. So that provides us with a wealth of data. So what we found from the analysis was that New York domestic insurers investments in 2019 had a meaningful exposure to carbon-intensive sectors. And the 5-year forward-looking capital plans for most insurers' investee companies in these carbon-intensive sectors were not Paris-aligned, except for a few areas. And in many cases, insurers' portfolios were less Paris-aligned than the market benchmarks. So we used the Bloomberg Barclays Global Aggregate Corporate Bond Index for the corporate bond market and MSCI All Country World Index for equities. So the fact that insurers' portfolios were less Paris-aligned than market benchmark means there potentially room for improvements just without within the investable market. So to give you a bit more details, we found that exposure to high carbon technologies varied dramatically among individual insurers. And while most insurers had a single-digit exposure to the fossil fuel sector, multiple P&C insurers and a few life insurers had exposures that were significantly higher. One life insurer was exposed more than 50%, and one P&C entity was exposed more than 40% in the corporate bond portfolio. And like Jacob mentioned earlier, there was one P&C insurer that had all its equity investment in one fossil fuel company. They have divested that position since then, but that was very significant. And I agree with what Anna said earlier, that scenario analysis can be useful for both macro and micro supervision. The fact that we see that overall, we see the overall exposure in aggregate for the insurers are meaningful but not too high, a manageable level, versus their individual insurers that have significantly higher exposure, and that's very useful information for us. So on the alignment with temperature scenarios, what we found was insurers were over-invested in coal and fire power generations and under-invested in renewables to be Paris-aligned, while their investments in gas-fired power generations were. And then for transportation, although insurers invested sufficiently in electric vehicles to be Paris-aligned, they under-invested in hybrid vehicles and over-invested in internal combustion vehicles. So 2DI not only generated the aggregate results, but also results for individual insurers. So we have been using these data as a starting point for discussion during the exams. So we started examining our life and P&C insurers this year. If we notice that insurers' 2019 exposure to carbon-intensive sectors were much larger than their peers, then we point that out and then we start a discussion with them. Some insurers have told us that they have adjusted their holdings because of the analysis and our expectations.
Yeah, thanks, Nina. Before we go on to we invite another panelist to speak, I understand the results of the second poll is ready. So if you could see, yes, so we can see the slide. So this second poll was asking, where could the IAIS and insurance supervisors add the most value in the area of climate scenario analysis? A, to promote consistent scenario analysis and assessment requests among supervisors. B, bring about alignment on the key elements and definitions of scenario analysis processes. And C, provide practical guidance on how to run such analysis. The results is actually quite balanced and mixed. 17 of you voted for A, 26 for B, and just a little bit more, 32 for C. Thank you so much for participating in the poll. So actually, I want to ask Reynold the same question, actually. What steps do you think from a licensed insurer's point of view can the IAIS as well as insurance supervisors take to make the scenario analysis process as smooth and as useful as possible?
Brenda, I think you're muted.
Sorry about that. That's operational risk. Thank you very much for that. I was actually saying that I wanted to say how much I concur with both of you, Anna and Nina. You highlighted the importance for a collaborative approach and the need, Nina, the need for three to work hand in hand. And I think that's really the key. And I think that's really to be able to navigate the uncertain environment on that. So speaking of being collaborative, I think that obviously coordination between supervisors is going to be as critical as ever to ensure consistency in the design of the climate scenarios, to ensure comparability of the output of the climate scenarios, and also to ensure we avoid duplication in the input, in the effort being performed to actually file in these various tests. So to me, that's extremely important. And I also believe that we should actually, and I can see that you can see on the screen. So can you see? Yeah, I think that there has been a tech issue on my end. Apologies for that. So I think also that it's very important that we avoid, to have variations between various methodological frameworks, which would mean that we have different governance, different data, different way of computing these scenarios. And given, the amount of uncertainty and the long time span that we use in trios, it's very important for us, climate scenario analysis as the basis through which we identify, we understand, we detect, and we monitor trends, rather than just, focusing on any given very specific, quantified result or any forecast which would claim to be very accurate, but that would probably be somehow delusional. So what we would encourage, more broadly, and because Anna, you referred to the debate between quantitative and qualitative, is that we rely on qualitative assessment, especially for the future management actions, because what we do believe is that, a quantified approach over such a long period where there are high levels of uncertainty could actually prove not to be adequate and could lead to far-reaching interpretations. And so, speaking of interpretations, we do welcome, the profusion of climate scenarios, and we think it's very, very important and it's very relevant. However, the last point I would like to stress is the need for all of us to make sure that whenever there are results available, these are interpreted and communicated on with great care, given the amount of uncertainty, that is actually inherent to the fact that it's a new field of analysis. It's a field where we have to go, but we have to go eyes wide open as to the very limitations methodologically of what we're doing. So we do believe that it's very important that we do not take, headline figures in isolation. Sometimes it can obviously be, mind-catching because those are sometimes dramatic, but it's very important that we always tie that to the set of assumptions, the set of underlying data that were used, so that we can properly assess what we are doing here.
Thank you, Renaud. I took, there are 3 great points you made. I took 3 C's out of what you said. Consistency of design, comparability of output, and communicate with great care. So thank you so much,
Yes.
for sharing those thoughts. I'm hoping that the panel will now go into this next segment where we can, several of us through the course of the last hour or so have highlighted some of the challenges and issues that we face to do climate scenario analysis properly and effectively. So hopefully we can, in this final segment, to better understand what these challenges that we all have to confront and consider, and what can be done to cross some of these hurdles. So if I can go back to Renaud again, as you have well shared, AXA has conducted stress testing as well as scenario analysis. And you must have encountered and perhaps already overcome some constraints arising from the lack of climate-related data. So in your view, what data gaps need to be filled to improve scenario analysis, and which are the stakeholders that will be key to address these gaps? And perhaps you can also then also share that how can insurance supervisors or the IAIS help in this respect?
Yeah, data is really the blood of all of this. So we need it. And here I think it's quite interesting because we are having a dialogue between insurance supervisors and insurers and reinsurers. And sometimes, I hear it's a dance between both constituencies. And it takes 2 to tango, but I would like to add, it takes 3 to party. So we should invite to the party the underlying economy, the corporates, the households, the emitters of carbon, beyond a mere dialogue between supervisors and the insurance industry. And there's only so much we, insurers, asset managers, asset owners, banks can do if there's no transformation of the underlying economy. So it's very important, I believe, that the underlying economy, well, not only performs its work by bringing more networks so that you can see me on the screen, but that's the role of the underlying economy and of IT providers. But more seriously, I think it's very important, that we get more accurate set of data as to the carbon footprint, the warming potential of various emitters throughout their respective sectors and the various industries to which they belong. And we do need a framework that will ensure access to reliable, robust, and comparable data. So we do welcome all the efforts in that direction. Now is really the time for convergence of the various frameworks, and I think we're very glad to see that there's a lot of regulatory and supervisory dialogue in that respect, and we would definitely, in our role and in our capacity, support all policymakers working in that direction. And that consistency should be complemented by transparency, and we need both consistency and transparency in the transition plans of the real economy, so that everybody speaks the same language. It's important, obviously, for the very climate scenarios we are discussing here and now, but also for more broadly our decarbonization efforts and our transition pathway to net zero.
So it does sound like to have that transparency, that you were referring to, we do need consistent and comparable disclosures throughout the economy, not just from the financial sector. So Nina, we've covered challenges faced by the supervisors earlier on, both Anna and you have shared, and Renaud just spoke about the challenges that the industry does face. How about the intangibles, in terms of mindsets and goals, for using Renaud's words, for the tree to tango, right? data providers, industry players, as well as regulators. What needs to change before all of us can move to this next stage in terms of mindsets, expertise, and so on?
Yeah, so I think it requires an all hands on deck approach, and I think it's so what we have found just from our experience is the partnership among the regulators through IAIS, through CIF, we're also a member of the NGFS. That has been tremendous learning opportunity for us. When I started a year and a half ago in this job, NGFS guidance guide for supervisors on analyzing climate and environmental risk was tremendously helpful for me starting this work. And we also very much benefited from the IAIS CIF application paper. And then also we found that discussion collaboration with our insurers, learning from what they have done, have also informed a lot of our thinking. So coming back to the guidance document that we released yesterday, some of the expectations in there were actually from what insurers told us they have been doing, which we thought makes a lot of sense. And then I think and then lastly is from the collaboration with nonprofits, with think tanks like 2DI, which also enabled us to do the analysis that I just described. If we had to do it completely in-house, that wouldn't have been possible. Maybe I will also, since we just issued the guidance, I was also highlight a few things that I find that I think are very important for our insurers to consider. So the guidance include the common expectations that we see in the IAIS application paper, and the PRA's supervisory statement, and others, such as scenario analysis should include both the impact of physical and transition risk, analyze multiple scenarios of different temperature pathways, consider both the underwriting as well as investments, and also the forward-looking aspect. So I think what we emphasized in the guidance is also that given that we're still in an early stage of scenario analysis, both for supervisors as well as for the industry, we expect the insurance analysis should focus on understanding potentially material risk, exploratory in nature, and the balance between quantitative and qualitative data and observation. And the goal for the exercise is to produce reasonably reliable outputs that are useful for insurers' decision-making and avoid creating a false sense of security and precision in the results. I think this echoes what Jacob said earlier, in terms of thinking about what's the behavior that we're trying to drive. We also expect insurers to use scenarios to understand the impact of climate risk on their probable maximum loss, solvency, liquidity, and ability to pay claims. And if insurers rely on reactive actions to mitigate these risks in a particular scenario, it should consider whether these actions are realistic. So again, going back to the behavior aspects. And lastly, I want to emphasize that scenario analysis can be a valuable tool for insurers, large and small, insurers that are not ready to conduct a comprehensive and quantitative scenario analysis should start with qualitative assessments and consider how various scenarios might impact their business and balance sheets.
Thanks, Nina. So for the insurers listening in, you have heard from Nina about, from a supervisor's perspective, how where you can learn from, and by sort of assessing yourself to supervisory guidance. But something that has been on my mind is for smaller insurers and less well-resourced insurers who are keen to undertake climate scenario analysis. Sometimes the work and effort required may deter their good intentions. This is an area that technology can possibly address. So I was just wondering if, Jacob, if you can sort of share your thoughts on, do you expect there to be technology or supplier solutions that will make the conducting of scenario analysis easier over time, especially for the smaller companies?
Yeah, I mean, absolutely. And I think it's so crucial for regulatory success. I remember that one of the key reasons why mandatory climate disclosure passed in 2015 in France as one of the first legislation of its kind was the ability to pick up the tail of smaller insurance companies who were a bit intimidated by the prospect. You know, it was, I remember AXA CEO writing op-eds in French newspapers at the time, but what really I think mattered for the law success at the end of the day is the ability to make sure, you know, that not everybody, but that you have a sort of the political capital in the industry, also among the smaller actors, for such types of actions. And again, no, you know, there's obviously pros and cons and different perspectives, but I think that's so important. And technology plays an absolutely fundamental role in this process. And I am divided about this because, you know, as a sustainability professional working in the financial sector, I understand that sustainability is complex. There's lots of ins and outs. We talked about scenario analysis, and you know, those things can run pretty long in terms of the different variables that they have. And that, I think, I'm sure there are many here on the call who are perhaps intimidated by this complexity that we've just interrogated here on this panel. But the fact of the matter is that it is effectively free for an insurance company to run a climate scenario analysis exercise, at least for a listed equity and corporate bond portfolio, and arguably for your sovereigns as well. So for most of what you're investing in, there are open source IP rights free solutions that you can apply. Now, somebody's still got to sit there and push the buttons and click on the things and so on. But, you know, the raw underlying analytical frameworks are there. And I think what's really interesting, right? My organization was involved, as you mentioned earlier, and as Nina talked about, developing this PACTA tool. And when we first developed it, back in 2015 at the time, it was really kind of trying to do something that was as cutting edge and as sophisticated as possible. Now, when we talk about development, the first question we ask is, can this be maintained as something that's accessible to every single insurance company in the world? And that's in some ways more important now for our research program than whether it is the most complex, brilliant, insightful piece of exercise, because we need that floor to be able to continue to drive ambition across the access of this world, who have more resources and who can invest more in more sophisticated exercises. You know, so I think that's really where it is sometimes a sort of an interesting conversation. You know, this is less so in the insurance and the pension sector. I'd like to name the example of in one of the European countries who work with the pension fund for the ski lift operators. And that's, you know, and I like to say, look, if this was, obviously there are a lot of ski lift operators in Central Europe, so I'm not saying it's that tiny, but it is obviously a very small pension fund with a handful of staff members, and they were able to run this exercise and even take a moment to process and think about the implications thereof. If that's the case, then the same is true for all the different insurance companies out there as well. So if you want to build the most sophisticated, complex climate scenario analysis exercise in the world, you want to take that Bank of England CBEST data and turn it into a brilliant model. It's going to be resource intensive, no doubt. But if you want to conduct scenario analysis, get your feet wet on the topic, there is no excuse for not doing it anymore from a resource perspective. Getting it on the ground floor is free. And I think that's where we need to build understanding, because there is still the stereotype of this is all an expensive thing to do. Now, getting in on the penthouse might cost a bit more, but there is great real estate on the ground floor for people to buy into, and I encourage everyone to do it.
Thanks, Jacob. So for the last hour plus, you've heard from all our panelists on taking deep dives into different aspects and facets of scenario analysis when it comes to the climate change and so on. So you've heard the challenges, but you've also heard many things about, you know, we are on this journey together. So I just want to give Anna the last word on all this. You shared right from the start the purposes and benefits of climate scenario analysis, as well as the PRA, Bank of England's approach. So looking forward, what would you expect supervisors to be able to do with the results from climate stress testing and scenario analysis? Do you see a link with solvency requirements?
Thanks, Daniel. I know that the solvency part of the question is the punchline, but if you'll allow me, I'm just going to run through to remind all of ourselves about the sort of range of benefits both for the supervisors and the firms. And I think that we've already heard a number of concrete examples. I was particularly struck by the equity holding that Nina mentioned. So as part of an ORSA, an insurer is itself obviously required to perform analysis to assess its own ability to manage its risks and meet its capital requirements under a range of plausibly adverse scenarios. And that needs to be forward-looking. As the CIF IAIS application paper on the supervision of climate-related risks in the section notes, that where material, this analysis should include the identification and assessment of direct and indirect impact of climate-related risks, for instance, including as part of the scenario analysis, a reverse stress testing process that would enable insurers to assess their own resilience to financial losses emanating from climate change. From a supervisory perspective, supervisory-led stress tests and scenario analysis may indicate exposures and vulnerabilities that could affect supervisory risk ratings, on risk management, on governance, on the risk coming from the business model, and indeed solvency requirements. However, whilst regulatory capital is not the right tool to address the causes of climate change in itself, so it's not the main place. I think that has to be for governance. It should have a role in dealing with its own the consequences of those exposures. PRA has categorized the gaps in the current capital regime into 3 broad groups: capability gaps, including hurdle to firms to capture risks fully within their own current risk and finance frameworks. These exist mainly due to lack of data, as we've heard earlier, or limitations in modeling techniques. Regime gaps for the micro-prudential regime due to the unique features and uncertainties of climate-related financial risks. There could be gaps fundamental to the way current regimes and current methodologies address these exposures, in particular short-term calibrations based on historical data. The regime gaps related to current macro-prudential regime. These kind of gaps are related to the way that macro-prudential regime currently addresses system-wide exposures to climate-related financial risks. Notably, the fact that tools currently deal only in a limited way with risks that increase over time. As part of the analysis that we're currently doing in our stress testing, that participating firm supervisors are very much involved in the analysis of the submissions, including reviewing the qualitative responses to business models and the risk management responses. This benefits the central stress testing team that we have here by ensuring that responses are understood in the context of that individual firm and its strategy, but also importantly provides supervisors with a view on their firm's own progress to meeting the broader requirements. As such, the exercise will directly inform areas of supervisory focus in the coming year and years to come. We've also been working with industry on improving scenario analysis capabilities through the Climate Financial Risk Forum here in the UK, an industry group co-chaired by the PRA and the FCA. We have a working group as part of that, which published a second round of guides just a month or 2 ago, giving practical examples of how firms can incorporate sector-specific points when developing an effective approach to scenario analysis. The content is aimed at banks, asset managers, and insurers of all sizes, and may be of interest to other institutions such as pension schemes. It provides further guidance for specific use cases on how to identify potential exposures to physical and transition risks and assess their financial impact under different scenario choices, as well as how to use the scenario analysis to measure portfolio alignment with the Paris Agreement and to aid portfolio construction. This working group is also developing an online climate scenario analysis narrative tool to support smaller firms, an example of the kind of resource that Jacob was talking about. The idea of this tool would be that firms would input some basic information regarding their business activities, products, or risks into the tool, and then that would be output a narrative description of the climate risks and opportunities, not numbers per se, but a guide to help those firms work out where to start looking. Finally, we recently set out here in the UK our latest thinking on the relationship between climate change and capital requirements. As I said before, a key finding is that the regulatory capital regime for the firms is not the right tool to address the underlying causes of the climate change, but can help address the financial consequences of climate change. Further work, we think, is required to identify whether changes in the design, use, or indeed calibration of the regulatory capital regimes are needed to ensure resilience against those consequences. And to help address this, we're looking to work with international partners and these kind of fora. And we've also put out a call for research, and we are looking to host a conference to discuss some of the complex issues with the aim of providing more guidance on our approach by the end of next year. So let's say at this stage, we would say it could lead to changes in the capital requirement, but let's not focus just on that. But let's come back next year and have a deeper discussion on those options. Thanks, Dan.
Thank you, Anne. Sorry to put you on the spot. Yeah, so you've heard from all our panelists today. So I think it has been a very fruitful and productive discussion. We have covered many different areas. So before we conclude, perhaps I can just invite any of the panelists here to maybe just share one key takeaway that you've learned from each other, or there's a particular point in your own sharing just now that you want to especially emphasize. So perhaps can we just go around? I'll just pick you from how you are aligned on my end. So maybe Nina, one key takeaway from on your side.
Yeah, so I heard a lot from the panelists that really scenario analysis is something that both not just large but also smaller insurers can do, and there are tools out there like PACTA which can be used. So I think my message for both my fellow regulators as well as the industry is everyone should get started. This is a journey, but there are tools out there such as the guides that the PRA's forum, Climate Risk Forum, has developed, and the PACTA tool that we can all get started.
Thank you. Jacob?
Yeah, I think I want to go back to a side comment that Anna made about this debate about the dynamic and the static portfolio and those trade-offs. And I think it's just so important to just understand that these trade-offs exist throughout this entire process, and that's okay. That this isn't some sort of a compromise of integrity, but that they're sort of attacking those trade-offs and engaging with them rather than being intimidated by this, oh no, how we're going to deal with a 20, 30-year time horizon and static portfolios. To say, all right, look, how we're going to deal with this. These are the options. And I think the sort of addition I would make is that there is value in simplicity. And that sometimes a trade-off is not just, all right, we do the more sophisticated version, but then nobody understands anymore, and what are the issues with credibility. And sometimes it actually just makes sense to say, look, what is the use case here, and actually getting a use case where the CIOs and the whole teams understand what happened and why may be more important than getting that last inch or that last drop squeezed out of the tube of climate scenario analysis. And I think just understanding that those trade-offs are there throughout that journey is, I think, really insightful, and they come in lots of unexpected places, but they're incredibly intellectually interesting to interrogate, I think, and sometimes can actually help structure a more targeted exercise by choosing simplicity over complexity, for example, and vice versa, of course.
Thank you, Jacob. How about you, Renaud? One key takeaway from your side?
Well, I would like, to broaden the perspective and also take stock of the many actions that are underway and that may materialize in the coming month and year on the policy making front. And just to give an example, I think in carbon pricing, which will obviously be a key driver going forward, because only what is measured and what is priced actually improves and incentivizes economic agents' behaviors. I think that, just like we were discussing earlier, management actions, we should also take into account the fact that when we develop and design climate scenarios and we run these, we should factor in the likely policy actions that will take place and that will shape our future, and more often than not, in the right direction. So it will steer the transformation and the underlying economy and help us in climate change mitigation. So I think we should, definitely throw that into the mix and take stock of the political will that is being expressed and that will translate into various actions. And I think carbon pricing is definitely one of these, and we very much look forward to it.
Thank you, Renaud. Maybe last but not least, Anna Sweeney.
Thanks, Daniel. I agree with the points already made. I think for me, as well as some of the just start and don't let the enemy be the perfect be the enemy of the good that others on the panel have flagged. I think this needs to be a real part of firms' risk management, a real part of the strategic decisions that they're making. So we're all learning, and we'll have, hopefully in a few years' time, we'll have even more sophisticated tools which are accessible to more, and we'll all have learned and narrow down some of the options. But the some of the strategic decisions and portfolio management decisions, as Nina example highlighted really clearly, are there to be taken now. So work on how to sort of build these tools into something that the firms use if you're a firm, but also then if you're a supervisor, sort of how are those the sort of this kind of analysis, is it how do you think it's informing the decisions that the firm is making, and is it real? Thanks.
Thank you so much to our 4 panelists for your really insightful sharing. And we've covered a lot of ground today, and I hope that it's equally been enriching for those of you listening as it has been for me. So I also like to thank the audience for your active participation. Certainly you have participated in the 2 polls. Unfortunately, we've run out of time, and we won't be able to do a Q&A, but I think the rich discussion over the past hour and a half hopefully has whetted your appetite. Just to echo some of the takeaways from the panelists. We are in this journey together, insurance supervisor, insurer, and the industry. So this is whether it's for firm level risk management or for broader financial stability purposes. These climate scenario analysis is going to be a valuable tool for all, whether you're a large insurer, small insurer, or you're a supervisor. So this is something that end of the day, it's still a means to an end, right? The end is an extremely vital one. This existential issue that I mentioned right at the start. And so let's all make this meaningful progress as we gain expertise, as we share and learn from each other on how to best use this tool for risk management purposes. So thank you, everyone. I wish you, at least from Singapore here, a very good evening and have a great rest of the day to all of you.
Thank you.
Thanks, Dan.
Bye. Thank you.
Thank you.
Thank you, everyone.